We have some good news. We've been looking for properties for the last 9 months, and the reality is that we're starting to hit the bottom of the market. And what we found over the last 9 months is that sellers have been having higher expectations than what a lot of buyers want. So what we found is that either sellers are saying we're going to wait till the market rebounds, or they're saying, okay, my price that I want in order to sell in today's market is higher than what Faris Capital Partners is prepared to pay. So the good news here is that we've had a broker reach back out to us after a number of weeks of us going after this property with multiple other buyers that were looking at this property as well. And the good news is that the broker told us on Thursday that our offer has been accepted. So that's what this podcast is all about. It's about this property. It's about the upside. We're calling this one a home run deal because it is just around the corner from where the Atlanta Braves play. And so we're going to be talking about the location. We're going to be talking about the unit sizes in this podcast. We're going to be talking about the overall returns. We're going to be talking about timelines as well. But if you've been watching this podcast and you've been thinking about potentially, what would it look like to be able to partner with us on a future deal? What do those deals actually look like? This is the episode that you want to listen to because this is going to be a preview. We haven't actually launched it yet at the time of recording, but you want to listen to this because we're going to be talking all about this strong upside of this deal that we've been looking for the last 9 months. And I'll tell you, it is very rare to be able to get this type of asset that is in this down market to be able to acquire it and to be able to capture this low price that we got. And the location of it is phenomenal. John, it's good to be here with you.
Mark, so good to be here, man. It's always exciting when we have a new deal to talk about with our investors and anybody listening to this podcast. Something we mentioned on previous podcasts that still holds true today is it takes 300 opportunities to come across our desk to find one that, we go after. And so it's a bit of a slog, but we actually really appreciate the process because we're getting such a view of all these assets across all these markets. And we're learning, right? Because at the end of the day, even if we don't make a bid on a deal, we're in the financials and we're in the rent roll. And so there's opportunities to learn there. But that patient approach is so critical. A friend of mine actually just left one of the big apartment developers and owners in the US and started his own fund. And when we connected recently, he said, the biggest challenge is like, you get desperate sometimes to a certain extent. You're like, we need a deal. But having that discipline to say, we don't need a deal that's bad. We need a good deal. And so we're willing to be patient and wait. And that's what that 9 months looked like. We had a few other LOIs we submitted along the way. But to your point, the seller's expectations were not in line with the reality of the market today. But the good news is some of those are circling back. So hopefully this is the first of maybe 4 or 5 deals that we're talking about this year. We have big goals and the bottom line is, though, we want to make sure we're delivering the best possible opportunities to our investors, hence the patient approach. So, Mark, I think it's really critical to jump in first to, what's most important in real estate. And everybody's heard this, right? Location, location, location. And I think first, let's zoom out a little bit and actually just look at the broader Atlanta market before digging into this sort of submarket, the Smyrna area that this particular property's in. But let's talk a little bit about Atlanta. So Atlanta is projected to rank number 2 in the nation for organic rent growth in 2026. And so this is various sources. This isn't just like one source saying this, but the projection averages out based on various sources to about 4.1% in organic rent lift. So if you're newer to this, what that means is that just based on, demand and supply, if you were to do nothing, rents will rise 4.1% based on current market rent rate. So we love to see that, right? In fact, Atlanta and a lot of markets across the US have seen negative lease trade out. Now, it's also critical to mention that when you're buying a value add deal and the property's rents are below market rents, even when you see negative lease trade out like we have in some markets that we've invested in over the past few years, we're still getting 4, 5, and 6, and sometimes 8 and above organic rent lift on a classic unit. Now, our goal is to renovate, but sometimes you do renew, right? And so long story short, Atlanta's projected to be number 2. We're super excited for that. But the key factor is you just can't look at the broader Atlanta market. It really does boil down to the submarket. So we're going to dive into that a little bit here. So in our world, we look for areas that have high population growth, great diverse employment opportunities, and then obviously strong demographics around average incomes. We want to buy a building where it's very affordable to rent. you touched on this, Mark, but in say, for example, Toronto, 50, 60% of income is going towards rent. On this particular deal, when we'll dive into the details here in a minute, but we're talking about 23, 24% rent to income ratio. So we love that. And in Smyrna, it is the most employment dense zip code in Metro Atlanta. So it is just like there are so many opportunities, which we'll dive into. So we love this deal. We love this market. So really excited to kind of continue to dive into the details here.
100%. So let's dive into the employment side of it. So one of the things that I noticed about this, you had said location, location, location. If I was to summarize this property, so it's 100 units as well. We're going to be diving into the property details, but just to give you a little bit of a sneak peek, this 100-unit apartment building is right around the corner from a $1 billion development. Now, that $1 billion development is called Truist Park, and that's where the Atlanta Braves play. So there's retail there, there's higher end offices there, Profit 500 companies. This is situated in one of the hottest spots in Atlanta. And what's really cool too, John, is that you're like 20 minutes away from the apartment as well. So you can, take the kids and go look at the building, keep an eye on it as well, in addition to our full-time property management that is on site. So you have Home Depot corporate headquarters close by. You have Cobb County Schools, which has 15,000 staff. You have Wellstar Health, NCR Corporation. You have the Cobb Galleria Center as well, which has 5,000 employees. And just overall, like Lockheed Martin has 8,000 employees right around the corner as well. Like this is all a short drive to this apartment building, which means the employment hub. Why that's so important is with this diverse employment is that when people are making really good income and where they actually go to work, they can drive home and they can pay the rent because they're making really good income. It's really jobs that helps drive real estate prices. And this being one of the hotter areas in Atlanta, there's a wide diverse of employment. So John, why don't you talk a little bit more about the diversity side of it?
Yeah. So, basically 52% of the residents in this market are working within that market. So, in other words, their commute is less than 30 minutes. But what's also amazing about this deal, Mark, is that it sits right at this perfect intersection where I-75 interstate that takes you straight into Atlanta or north into, other employment areas. And you also have 285, which is a perimeter highway that runs around the city. So it's very easy to navigate Atlanta. So, for example, maybe you like the proximity to Truist Park and the Battery, which is that Atlanta Braves live, work, play development we touched on. And you just like the area, but you work in Midtown or Buckhead, which are two major employment hubs. You're like still within that 30-minute commute radius, right? With traffic, maybe 40, 45, just depending. But, we touched on Home Depot, but even the Braves Truist Park employs 1,500 people. We have Racetrack, which is a large gas station chain in the US that have like super elevated experiences. So it's a really great company. Their corporate headquarters are right there. Papa John's, HD Supply, which is a building construction supply company. But then you get into the city and you've got Delta, Newell Rubbermaid, Coca-Cola. So all this is right there within that 30, 45-minute commute window. So that diversity in employment is so huge. And just in a 3-mile radius around our property, the unemployment rate is 2%, so well below the national average, making this one of the tightest labor markets in the metro area. So we love that. Now, because of this, like all these opportunities, the average household income in a 3-mile radius is $98,000, which is well above the national average. Median household income does come down a little bit at 75. But what's also important to note is the average home value in the area is between $440,000 and $455,000, which makes home ownership a lot more expensive than renting. So 67.5% of the residents in that 3-mile area or the population rents. So it's a heavily employed, making good income, but still renting population. So just a great story and a huge opportunity for a building such as Brighton Way, which we are going to rebrand to Faris Residences Smyrna, because these are all in classic condition. So when we come in with our premium renovation package and our 28-day transformation, just completely transforming the amenities and exterior look of the building, we'll be delivering rents that are still at 23 to 24% of average income. So that rent to income ratio is so far below where typically you're targeting 30 to 35%. So when we see a deal like this, it just means, we have no doubt we're going to be able to deliver on our rents. And our rents are frankly conservative, Mark, as you know, right? So our goal here is to exceed these
Yeah.
projections, just to be clear.
Yeah, 100%. And to give you context, so this 440,000 to 455 is the average home value. To give you context, we got this property at 154,000 a unit. Like, just so you have context, 154,000 a unit, and the units are over 1,000 square feet, which they're actually large, which we're going to be talking about in a minute. But we bought it for, we locked in a price that our partners are going to get access to at 154,000 a unit, compared to 440,000 to buy a home. So the reality is there's a huge gap there that we're able to get lock into. And we're only going to be charging, after we renovate and increase rents to $1,450 is going to be our average rent. So that you can see from a value standpoint, it makes sense that more people will be renting in that area, because home ownership is not just like a little bit above, not even like double of what a unit would be in ours, but like it's like three times more to be able to buy a home than what we bought this for at 154,000 a unit. So that gap is actually something that John and I, with our background in residential, we're very mindful of that, because when you're working with a buyer, it costs so much to live in an area, and you're either going to go buy a home and you're going to have to spend X amount of dollars, or you're going to rent. And when there's a huge gap like that, it makes it way more, we'll say the reality of the situation is that most people will not be able to own. And so that's what we're filling with this opportunity. We're filling a major need in the marketplace for really strong, great communities and great, we'll say, safe places to live on a day-to-day basis that's close to employment.
Well, and I'm going to jump ahead a little bit here, Mark, but you touched on that per door cost of 154. So just to put that in some context, there's a few recent trades I'm going to cover. So Cortland, which is a major property owner and developer, they recently acquired a deal, now rebranded Cortland at Cumberland, at 181,000 a unit with a 1982 vintage. We're 1984. Renew Marietta, 81 vintage, 170 a door. Arrive Vinings, which was actually a 71 vintage, which we typically shy away from. We have taken down 170's deal, and it's an incredible deal, but there was a lot of basically we got that one at 95 a door, so it made sense. But this one traded at 167, and the Arlo, a 75 vintage, traded at 162. So we're getting a newer asset below market value and well below replacement cost, which is also an important factor. So it's just an incredible deal, no doubt about it.
John, we got it at such a good price, and we weren't even the highest offer on this.
That's right.
Right. And so Joe did an excellent job on our team. He did an excellent job negotiating the final details with the owner. And the owner, one of the reasons for selling is that he has 10-year debt that he put on this building 10 years ago, and that's coming up for expiry, and it's maturing here very soon. So one of the things that was really important for the seller is that we were going to close on time. And so that's something that we were able to commit to. We just had closed on 114 units just south of Atlanta and Noonan, and we closed on that with no problem. And so not only that, all of our other assets under Faris Residences, we've closed on time. There hasn't been any sort of issue. So we had all this broker feedback coming in, and how we handled this deal in the negotiation as well, the broker really liked. And so we were able to get a really good price, and especially at the end there as well, where there was a little bit of pressure, Joe was able to hold on strong. And the 154,000 a unit, when you're comparing that to new replacement costs, you're like easily 350,000 a unit for all in costs. Like, we're talking 154,000, including the land, per unit. And John, I'm really excited to talk about the size of the units as well and the overall condition, because it's like 154,000 a unit. It must be in distraught, right? It must be like low occupancy, high vacancy. Let's talk a little bit about the property condition and the unit sizes as well.
Well, just to even answer a few of the things you just surfaced. So this property is 98% occupied. So part of that is that they have been marketing these rents below market value, right? So I think there's probably had been a missed opportunity to push rents a little bit, but we love that as a buyer coming in, because we're below market rents. So even if we weren't renovating units, which we are, we would have some upside just baked into that, right? And operationally seems to be run really well. The property manager is friendly and nice, and did a great job on our tours. The maintenance team is solid. Property's in actually phenomenal condition. What I think some of their challenges were they weren't actually updating and upgrading along that 10-year process. So it's sort of like what I would call a heavier turn, right? So when I say turn, when a resident moves out, you often have to paint and maybe put some new carpet in, depending on how worn it is. So what they're doing is along the way, they're painting and maybe they're replacing some of the appliances, or maybe they're, putting in some laminated vinyl tile flooring. But for example, they're not putting down new countertops. They're not updating the bathrooms. And so it's just kind of like a heavier turn versus a renovation. And so in my view, these are like effectively in all 100% classic condition. Now, it's also a split evenly 50-50 between one bedroom units and two bedroom units. And all the one bedrooms are the same. All the two bedrooms are the same. They also have higher square footage on average than the competition. This is a theory the broker has, and I do agree with it. There's no way to bear this out, but in the 80s, there was a development process where apartments were being built with the mindfulness that maybe somebody would want to convert these to condos in the future. And so we believe that's what happened here, because they are about 100 to 200 square foot more than other comparable 1980s vintage floor plans in the area. Each property has a fireplace, and besides, so you got like a family room with a fireplace that kind of like is floating about 2/3 of the way through the family room. And then on the other side, there's like a sunroom area that could be used as an office or a reading nook or just an additional living space. Huge balconies. So these are very attractive floor plans. The units on the top floor have massive vaulted ceilings that are probably like 15, 16, maybe 20 feet tall. And
Yeah.
so it just doesn't feel like an apartment.
Yeah.
And the beauty is that our two bedroom units, they're two bedroom, 2.5 baths, which is very rare. So there's actually a guest bathroom in those two bedroom units, which is something I don't actually think I've seen in an apartment in all the deals we've toured over the past few years. So, just very attractive floor plans. So our opportunity is really to come in and just get these property or get these units like looking modern and fresh with our signature renovation package. And there's comps in the area that are 80s vintage that are getting $200 more than what we're projecting in rent. Now, candidly, the one particular property I'm thinking of is a Cortland deal, and it's kind of, massive. I think it's like 1,600 units. They've got a few pools, tennis courts, so it's a bit different than what we're doing. So our view is if we can demonstrate a tremendous amount of value as compared to that asset that's just down the street with rents $150, $200 below where they're targeting, somebody looking for that, like, hey, it still feels really nice and beautiful. But maybe I'm not going to use the pool and tennis court, so that's not as important. Now, to be clear, our property has a pool, so we do have some great amenities. And in our typical fashion, we're going to come in and add a playground, add grilling stations, game stations, redo all the pool furniture, all the fencing around the pool, really tighten that up and make it really nice. There is a dog park, which we're going to enhance. It's really more of a dog walk. So all those signature renovation updates we do will be in place. So really excited that I think residents in that area, it's kind of a missing middle. In other words, there's sort of this unrenovated stuff, or there's like Class A, down near the Battery that's like $2,600 for a one bedroom. That one vintage I mentioned, that at Cortland deal being close by, that's the comparable that we're sort of setting in a sense as our North Star, but with the goal of coming in beneath it. So really excited for this deal, Mark. I think it's an incredible opportunity and one that we don't see often.
Yeah, 100%. So the overall value add business plan that we're going to be doing is we implement our 28-day full out transformation plan. So John, you just mentioned a lot of items that will be done. We're going to come in from a property management. We're going to be assessing the existing property manager. A lot of times we'll change them out to somebody that's actually really friendly and has a genuine love of people. We come in with our guarantee. So like one of them, for example, is within 48 hours of a maintenance request is not done, then we'll actually give a concession, holds our team accountable. We'll do all the exterior landscaping and a lot of the stuff that you already said. Within the first 28 days, we rebranded to Faris Residences Smyrna. So it's going to be a complete facelift very quick. That's our goal, is to move very quickly. And then the goal is to renovate 50 units over a 3-year time frame. And so each unit renovation is going to be about $18,000. Now that's a little bit above our other costs because of the size of the units. Like they're really, really large, but we've stayed on track with our other renovations. And because we're not doing anything like breaking walls, we're very confident that we're going to hit our numbers with the renovation. And that actually lowers risk when you're investing in a deal as well if you're not doing major renovation. So we're going to do that over a period of 3 years. And then we're going to be looking, so 50 units is what we're going to be renovating out of the 100, so half of them. And then in 3 to 5 years, John and I and the team, we're going to be assessing, okay, is this the right time to sell within that 3, 4, 5 year time frame? And when we believe it's the best time to be able to overshoot our projections, we're going to be exiting, and then we're going to be returning the funds to our partners with all the profit there. And then you'll have the option as a partner to be able to make that assessment. You know, do we want to do it again? I had a really great experience, and let's double down on that next value add deal or not. And so that is something, the 3 to 5 year time frame. That's the exit. And why don't we talk a little bit, John, about the returns
Yeah.
and what does that look like? Because we do have a few different share classes.
Yeah, so we do, right? So Class A is a share class we created for investors that really prioritize cash on cash returns. So basically, how it's structured is it's a 12%, cash on cash return, but with no participation in the upside. So a lot of our investors that choose that class are either at a stage in their life where the income is more important than the upside. A lot of our investors actually spend time in the United States throughout the year, right? Whether they own property down here or just, spend a few months during the winter months in Canada. Maybe they perhaps come down to Florida to enjoy some of that Naples weather that you get to enjoy throughout the year, Mark. But at the same time, they like to have that US dollar cash coming in. And so, it's not a share class that's fully available, right? In other words, there is a cap limit on it. So if you're interested in that share class, you need to act fast. But basically, for those that are in share class B, C, and D, we're targeting returns basically between 18 and 20%. Now, if you're interested in learning more, book in a call and we can get down to the weeds in terms of the share class and what those returns are projected to be. But bottom line with B, C, and D, it's really a factor of the more you invest, the better your unit economics. So, in other words, we actually give you more favorable splits if you invest more money with us. So we're really excited to introduce those classes. We did it on our previous two deals, and a lot of our investors were excited to come in at 750,000, $1 million plus because they've seen our track record on our previous deals. One thing we're super proud of is we've never missed a distribution. We've never had a capital call. And we write our deals in such a way where we can't always predict the future, but we're very conservative with our underwriting. So it's something we're very proud to report on. So we are targeting, to your point, an exit in year 3 to 5. We are underwriting this at a 5% exit cap rate. CoStar, which is, it's a great resource, but it's in no way perfect. They're actually projecting 5.3, but the reason we're at 5 is that is across the entire market with every asset class included. So that'll include, your C assets as well as your A. So we believe that with a well-positioned 80s vintage property in a market and a location like this, that we can actually outperform that average a little bit. But we're happy to dive into more of our thinking on that if you had more questions there. So all that to say, I think one last point, Mark, on my side, and I know you might have others, is how do we think about risk on a deal like this and how do we mitigate risk, right? So number one, we've already touched on this, but our entry price on these units is below recent comparables. So we've already got some margin of safety built in right from day one. Because we're also targeting rents that are at 23.2% of average income in the area, we're going to be very affordable. So we know we'll have a deep resident pool that will be interested in this. We are also in flood zone X, meaning there's no flood insurance required and there's been no flooding. Actually, the property sort of, in a sense, sits up a little bit on a hill. So, I mean, like Noah's Ark would probably float by before we had any flooding at this property. It is no near developable land within a few mile radius, right? So this property actually sits in a parkway where there's some businesses, there's apartment buildings, and some office condominiums. So it's fully developed, so nothing can be built within any proximity of our property. And any properties that are being built in that submarket are all Class A high rises and mid rises that are targeting rents on one bedrooms like $2,200 to $2,400 and higher. So totally different resident pool than we'll be targeting. I think this is super critical, but when we talk about that budget, that 18,000 per unit and all the renovation costs on the exterior, we're not just making these numbers up. We had our contractor come out and do a full tour of the property, and he's back checked our numbers. And ultimately, this is the group that's going to be doing the work. So, like, if they're comfortable with the numbers, then we're good to go, right? And we also wanted to take a look at every single HVAC system because it's an older vintage. So we went, literally compressor by compressor with the contractor and nailed down any that need immediate replacement and any that might need future replacement. So very conservative here. And once again, our rent growth projections are in line with what are seeing in the marketplace. So this is a great deal, man. It's very clean, straightforward, value add play in a market where deals like that are very rare.
Yeah. And John, I'm sure the listeners can get a feel of how excited we are because we truly are excited. One of the things as we're wrapping up here to really consider is that when you look back in history over the last, since I've been in real estate for the last 20 years, John, I know you have
Yeah.
as well, that market cycles happen regularly. There's ups and downs, but real estate is like a yo-yo going up an escalator. And so right now, when you look at the track record of what's been happening and the dip that's happened, we're bottoming out in the market is what we've identified is where we're at in the market cycles, what we've seen. And so the ability to take action when there's uncertainty in the marketplace, when I look back over the last 20 years, every time I took action and the time that I've seen our clients and partners take action in a down market, those were the ones that were most rewarded, the ones that had courage and stepped forward in a time of uncertainty. Well, we're at that point today where the market has come down. There's lots going on in the world. There's a lot of uncertainty, but income producing real assets in today's economy is a phenomenal move. And so I just want to really encourage you guys that taking action today is what will down the road your future self will thank you for. And in our opinion, from what the data is telling us and from the last 20 years of experience, the next steps for you, if you're interested in learning more, is to book a one-on-one call. If we both think it's the right fit, then what we'll do is get you approved through our investor process. So there is a process that our partners do need to be approved. Once you're approved, then funding is very simple and easy right through our investor portal. We are expecting to be fully funded on this very quickly because there's been such demand for our assets because we closed on our last asset 6 months ago, 114 units just south of Atlanta and Noonan. But we found that 9 months ago and we've been hunting for a deal ever since. And we just found this today. So there's been a lot of demand pent up and this deal is going to sell out very quickly. So we will be fully funded by June 1st. And it is first to fund, so we expect it'll be filled before. We have an A-class share of $2 million of the $10 million total equity raise on this. That will fill very quickly as well. So make sure if you want the A-class share that you let us know very, very quickly. So the steps, we're going to be closing June 15th as expected closing date. Then from there, it'll be monthly distributions, ongoing monthly updates, and then the exit's going to be 3 to 5 years, upon which the return of funds will be given and the overall profit in the deal will be split amongst the partners. So really want to encourage you guys, book a one-on-one call, reach out to us today, and don't delay because this deal is going to go very quickly. Thanks for coming on to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.